All right, my friends, this will be part 2 of our thing on income annuities. So here we're going to talk about what happens if you do a joint life with period certain, which is my recommendation, actually, joint life with period certain. And this is what you should do as opposed to what we just did, the joint life. And let me show you why. So again, looking at USAA, I said, what's a joint life with a period certain? And I'll explain. Let me just explain what that is. So a joint life with a period certain is Charlotte and me. We're both 65 years old today. And we say at the end of the day, we're going to get paid for as long as either of us are breathing, but we want to make sure that someone gets paid if we die earlier than 10 years. We want to make sure someone gets paid for a certain amount of time after that. So in this case, a joint life with period certain is 20 years is what I recommend to everybody. And so let me just go over what that means. So we have me, 65, we're both 65, but we're going to have a 20-year period certain. You probably can't read that, but that means we're 65 years old, 20-year period certain. So that means we are guaranteed, if nothing else, that if I die tomorrow and she dies in year 10, that the next 10 years, somebody, my kids, my estate, the church, somebody's going to get paid for the next 10 years. So a quiz. If I die tomorrow and she dies in year 17, how much longer is USA on the hook to pay our beneficiaries? I die tomorrow, she dies in year 17. I heard you out there, 3 years exactly. So if Charlotte dies in year 17, we still have 3 years left under the contract because we have a 20-year period certain. All right, so we're guaranteed somebody is going to get paid for 20 years. Partly be us, maybe it won't be us, maybe we won't survive the 20 years. Someone else will get paid that is important to us. All right, so that's what a 20-year period certain would be. The reason I like a 20-year period certain is because the payout from a USAA annuity on that is only $474. All right, so literally it's $10 a month lower than what the joint life was. The joint life was $484. A joint life with 20-year period certain is $474. So it's only $120 a year less. I mean, that's okay to lock in 20 years of guaranteed income for sure. Now, what happens in this case, because this pays $474 a month, we know for a fact that we will get at a minimum. Nothing will change here. We know we will get at a minimum $113,000 times 20, 240, $113,000. So guaranteed. 113,760 to be precise, guaranteed. We know for a fact we're going to get at least 13,760 more than what we put in, no matter what. Now, people say, "Oh, that doesn't seem like that good." Well, you're getting all your money back plus $13,000, almost $14,000. So if you both got hit by some drunk driver tomorrow and you're both dead, you know for a fact that somebody, be it your kids, be it your church, be it your neighbor, be it old Josh, someone's going to get another $474 a month for the next 20 years. So it takes some of the risk out of the unexpected demise of just an income annuity based on the lives. Now we're saying we know for a fact someone is going to get paid. And so I would absolutely take that trade-off for for $10 a month less to have a guarantee of getting some money, not only my money back, but also a little bit on top of that. Now, you're not going to get rich. And if you live 20 years, you're only going to make $13,000. Well, let's just look at if you live 20 years on the other scenario. Well, the other scenario was just joint live, and we'll just say the last person died at the end of year 20. You're going to only going to make is 484 times 240. You make 116. All right, so you're saying 100,000 to 116 versus 100,000 to 114, all right? Roughly, yeah. So at the end of the day, is it worth an extra 2,000 or less, 2,000 less to guarantee I get 114,000? And the answer is absolutely it is. So the same thing goes by. If you live 25 years or 30 years, you're still going to make $474 as long as somebody is alive. All right, so that's how a joint annuity with period certain works. Incredibly important to understand that. So what you're doing, if you're going to get a quote, you want to say, what's my joint life, just my wife and me, my spouse and me, my partner and me. You don't have to be married. It doesn't have to be. Just what's my joint life versus what's my joint life with period certain. Now, if you do a 10-year period certain, I don't like a 10-year period certain because if you're doing a period certain, you're typically doing it because you want to make sure there's a residual value if you die early. All right, so secondly, you also want to make sure you get your money back. And so if you do a 10-year period certain, I didn't even run the quote, you're not going to, after 10 years, you're not even going to get your principal back. You're just not, because you're only getting a certain amount of money for 120 payments, which won't even be enough to cover the initial premium. It just won't. So do the 20-year period certain, at least that way you know for a fact you'll get some principal back. Generally speaking, income annuities, it takes about 15 to 17 years to get your principal back. All right, so at the end of the day, if anything less than 15 years, you're not going to get your principal back. There's just no other way around that. And that might not be a big deal. I'll leave that up to you. But generally speaking, if you do an annuity, you really want it to be about 17 years to make sure that you get your money back. And if you do a 20-year period certain, you're going to guarantee you get your money back plus a little bit of residual interest on top of that. And I think that's absolutely worth doing. All right, so let's... Excuse me. Sorry about that. All right, let's do, did you catch that? That's funny. All right, so let's do now, let's see, let's do another one. All right, I'm gonna come back and do just a lifetime. So the next one we'll do is just annuity on, what is it going to do here? It's going to do annuity. We got life. We got joint lives, period certain. Oh, just 20 years. Oh, let's just do that. This is another period certain. So this says not joint life, just period certain. All right. So this is $100,000, 20-year period certain. All right. So we have joint life, period certain, and then period certain, not joint life. So this just says we know for a fact that someone's going to get paid for 20 years and then not get anything else. It has nothing to do with your life. It's only got to do with the fact that USA is going to take your $100,000 and they're going to pay you out a certain amount every month for 20 years. After 20 years, it stops. So it's not joint life. So you do not want period certain by itself if you are worried about longevity. You just don't. All right. Now, there might be a reason you want that. You want to cover the cost of a life insurance policy. And one of these days I'll get into some strategies on using annuities with life insurance. But for this case, or you want to cover the cost of a mortgage or some fixed cost, student loan payment or something like that. But for what we're talking about in retirement plan to give you enough income to live on, we don't want period certain other than joint life period certain. So you got to know the terminologies. Joint life period certain, and just period certain. All right, so now with a period certain, you're going to get $561 a month. All right, so $561 a month. So that equals $561 times 12. That equals $6,700 a year, which is a 6.7 distribution rate. All right, so 6.7 distribution rate, we times that by 20. That means we are guaranteed to get $134,000. All right. So 100,000 period certain is guaranteed to give us 134,000 bucks. That's what we'll get after 20 years, and then we won't get anything else. All right, so now we take our trusty calculator. We say, okay, what was it? Our payment was $561 is our payment. We start with 100,000 bucks. Did it for 24 payments. No future value. So our rate of return there will be 3.12. That'll be our interest rate. So even though we have a 6.7 distribution rate, distro rate, our interest rate is 3.12. All right, that's our interest rate. That's our rate of return. So we know we can bank on it. We know for a fact that we're going to get, somebody's going to get either me or it doesn't matter. Somebody's going to get $34,640 back on $100,000 I put in. And they're going to get that each and every month for 20 years, which we know for a fact will give them a 3.12% rate of return. That's just no getting around that. Now, for instance, say you can borrow 20 years at 0%, and you can put in this annuity at 3.12. Would that make sense? Yeah, absolutely. You're going to make money. No other way around it. You're going to make money. Now, that will be taxable. All right, you're going to have some tax. Again, you won't have tax on 3.6%, because 3.6% of the 6.7 is your return of principal. Again, if it's a non-IRA, if it's an IRA, it's all tax. But if it's a non-IRA, 3.12% is taxable as income, where 6.7% or 3.6% is return of principal. So you know you're going to pay ordinary income on 3.12%. Let's just say you're in a 12% tax bracket, 0.12 minus 12%. That means you'll net 2.75. And so here's just about basic mathematics. If I can get a loan at less than 2.75, I should do this without question. No getting around that. Now, you are going to lose some liquidity, right? You no longer get $100,000 cash money, but if you're borrowing it and you say, look, so what you could do is say, I know I'm going to get $561 a month back over 20 years. And you say, okay, net of taxes, let's just say 500 for simplicity. You say, I can borrow from you over 20 years and pay you $400 a month. This is just basic arbitrage. I will borrow from old Josh over here, and I'll pay him $400 a month back. I'll put in this annuity, and I'll get $500 net of taxes. I'm making $100 a month. That's the arbitrage. Now, do you think banks don't know how to do that? The likelihood of you finding a 20-year loan that's going to pay you less, that you're going to pay less than 3.12 is not going to happen. I mean, even mortgage rates, which are secured by your house, aren't paying 3.12. Well, what if you did an annuity back when the rates were low? Well, the annuity rates were low back then too, my friends. And the only reason why, the banks know this. They know exactly what arbitrage is. And that's exactly what a bank does. They're using your money. They're giving you 2.5% of the bank of the CD to loan out at 6% in personal loans or 5% in mortgages or whatever. They're doing the exact same concept this right here would be. And so in this case, USA, they're going out and buying essentially 15, 20-year government bonds. They're paying about 3.5, roughly. I'm just using that for an example. And they're going to turn around and pay you 3.12. All right, so they're doing this already. So if you might see a time where an arbitrage opportunity presents itself, but you're going to have to dig deep. It's really going to be a needle in the haystack. But if you can find it, that's great. Now, on the other hand, let's say you're thinking the markets are going to go down. All right, so you're like, I'll take 100,000 out of the market. I'll turn around and buy a 20-year period certain annuity, and I'll get $561 back of interest, and I expect to get 8% a year. So I'm going to avoid the market. I'm going to get $561 back of interest. I expect the market to give me 8% a year for 240 payments. And then I'll have $330,000. All right, so here you're saying I expect the market is going to, just crap, and I'll lose 40% of my principal. So let me take that money out now, so basically lock in a higher market, turn around and buy an annuity with it, which will pay me $561 a month. Let me just make sure I got that right here. Right now, I'm going to invest that $561 a month. Actually, let me just write that out for you. It might be easier. What if I do this right here? Does that make it better? Yeah, not really. A little bit. All right, so let's do this. So now I'm saying, okay, I got $300,000 in the market. I'm worried about market taking a dumper of 40%. So I'm worried about a 40% decline, which will lose $120,000. I don't want that to happen. All right, so what I'm going to do, I'm going to take $100,000 out. You see that right there? So I got $300,000 in. I'm worried about a 40% decline, which would make me lose $120,000 out. So I don't want that to happen. So what I'm going to do as a hedge, so I'm going to hedge against this happening. This is exactly what a hedge is. I'm going to take $100,000 out. Right now, I'm only going to leave $200,000 in the market. So now I got $100,000 secure in some kind of fixed payment, some kind of guarantee. And I got $200,000 that's still in the market. So this could go up, this could go down. But we know for a fact this will only go sideways. We know that for a fact. I'm going to get my $561 a month. I'm going to dollar cost average into the market. That simply means dollar cost averaging. I'm putting $561 a month each and every month into the market. All right. Now, if I expect a 10% let's just use 10% because after the market took a tank, we'll just say it's going to pay us 10% a year. My payment, 10%, and I will have $426,000 in 20 years. All right, so I have $426,000 in 20 years. I avoided that $100,000 decline. Now, what would this have grown to? Well, this would have dropped. Let's say you call it right, and that drops. What did I say? 40%. So 40% would leave me, was that 120, I think? Yeah, 120. So this will leave me 120. All right, now that grows at 10% a year. 10%, oops, so we got bear with me just a second. We got 120 present value. That'd be worth if that grew at 10% a year, that'd be worth 1.3 million in 20 years. So you can see, that's a nice little arbitrage. Just because it fell 40%, and you called it right, you still say, I think it's going to go 10%, but I don't know. All right, let's just make sure I got my numbers right. 120,000 present value. Let's just do this. Bear with me just a second. We're going to do it. 120,000 present value, zero payment, 20 years, 10%. Oh, 807, excuse me. Okay, so 807. It's $807,000. Yeah, I screwed that up. All right, so we got $807,000. So essentially what you've done here is you took a third of your portfolio out to annuitize it to get this right here. And now that third of your portfolio that you took out to protect essentially has grown enough to be worth a half of your overall portfolio. Or that's still about a third, right? You got 100,000 to 300,000. That's 33%. So now we got your total portfolio. Now you got 426 by 1.2. 426 by 1.2. That's 35%. So you're able to increase a little bit, not much, but you're able to save yourself a whole lot of risk and a whole lot of downturns and a whole lot of maybe sleepless nights because you knew for a fact that you had that 561 coming in. Again, is that going to happen? It's up to you. But that's a strategy. I wouldn't do it, frankly, just because I think the equity market is going to go up and go down. If you need the money to pay bills, well, get it out of the equity market to begin with. That's just a fact. But you can see there's a million different strategies you can use this for sure. A million. You can say, forget a 20-year one, I'll do a 10-year period certain. All that's fine. But at the end of the day, I just want to talk about income annuities for retirement planning and how they can be used very successfully for retirement planning, which is a lock-in an income stream that you simply can't outlive if you do a joint life. Again, my recommendation is always joint life with period certain. Do a joint life with period certain. I know for a fact I'm getting $574 a month or $10,000, but whatever it's going to be. I don't care, but you know that's going to happen each and every month. And if you and your wife die in year 5, you know that your heirs are going to get the same $575 a month for the next 15 years. If you die in year 5 and your wife lives to 30 years, you're going to get still, you as a unit, she will get that $575 and for the next 30 years until she dies. I mean, that's all that matters. When she dies is when the money will stop. So I love the joint life with period certain things. I'll do a comparison to a bond here in just a second. I don't know if maybe I'll do that in a different day because I got to go take a kid to tennis game. But at the end of the day, don't overlook income annuities. I love them for sure, and you should too. Now, just all this. Remember, I can't stress enough. Once you do it, you no longer have access to that principal. The principal is gone. You cannot take lump sum distributions. You can't borrow. You can't do anything. It's gone. It's there. It's going to pay you this amount of money for the rest of your life, which is a good thing. But just remember that. And they are taxable. If they do an annuity from an IRA, you're going to pay income tax on the distribution. Guess what? Let me tell you some breaking news. If you take a stock out of IRA, you're going to pay tax on that distribution. There's no getting around the tax situation. If it comes from a non-annuity, a non-qualified account, a taxable account, you're going to pay tax, I don't have it up there anymore, what's called the exclusion ratio. You're going to pay tax on some portion of it, that's your interest, and you're going to get tax-free on some portion of it as well because you're getting your principal back. That's return to principal. So that's how annuities work, all right? Now, how much commissions? I have no idea. USA don't charge commissions, so that's a nice thing, but a mutual company that's owned by its members, the membership has to become a member somehow, and because of that, they don't pay commissions on it. But maybe you're looking at a guy who does. I don't know. So you'd have to ask him, what's the commission on it? Because essentially, the more the commission, the less you get. There's just no getting around that. So hope this helps, my friends. If you have any questions on income annuities, let me know. Fixed annuities we'll go into some point. Variable annuities, I've gone in before, and I'll do it again because I do think variable annuities can play a role in certain situations. They're not huge situations that can play a role, but I think there are some benefits there for sure that get overlooked. But as you can tell by fan of income annuities, the research now is overwhelming, over the top about the need for income annuities and retirement planning. It's not debatable anymore. So when you hear a guy like Ken Fisher, who I actually like, when you hear a guy like Ken Fisher says, I hate annuities, he's talking about variable annuities with high costs. He's not talking about income annuities, and he states that explicitly. So I just wish they didn't throw the baby out the bathwater, because I know for a fact, I've talked to many people who said, don't talk to me about annuities. I'm like, well, what kind of annuity you're talking about? They said, no, I don't want to talk anything about it. Don't do that. That's shooting yourself in the foot. At least understand what they are and how they can be used to benefit you. Why would you just say, don't tell me about this product just because you've heard Susie Orman or Dave Ramsey and Ken Fisher say they don't like annuities? Hell, what annuity don't they like? I mean, that's like saying I don't like life insurance. Okay, you don't like term? Oh, I do like that. Oh, well, that's what I'm talking about. Don't throw the baby out with the bathwater. There are good and bad to everything, and you understand the good, and then you can throw out the bad. But don't just throw out everything because you think it's all bad. It's not. I'm a huge fan of annuities, so income annuities in particular. All right, don't forget to subscribe, my friends. Comment down below. Next time I'll go into... I'll probably do more on annuities with just like when I start looking at how you can use annuities to fund a life insurance policy. Now that's a wonderful strategy, and especially when it comes to paying off your income tax that is going to be due to your heirs if you're trying to leave some money to your heirs. Life insurance is tax-free. IRAs are not. So you fund a life insurance policy while you're younger and in good health with an income annuity like this. That's one of the best strategies there are. And if you live in a state with estate tax, it's even better. Now, we don't have any federal estate tax much anymore, so it's not as beneficial as it used to be. We have these bypass trusts and all these things, or irrevocable life insurance trusts, ILITs. But man, you can make a pretty good charitable contribution to a charity of your choice, or if you just want to leave money tax free, life insurance is the best thing you can do. There's no getting around that. Roth too, but in terms of creating an estate right now, you can't beat life insurance. But how do you pay for it? And I'll use this as an example here with $100,000 going into a policy. All right, my friends, we'll see you next time. Thanks now.